Welcome to our webinar looking at the LPL Financial Outlook. I'm Sarah Carlson. I'm the founder of Fulcrum Financial Group. Thank you so much for joining us. We have a special guest today, Jeffrey Roach. He is the Chief Economic Advisor at LPL and Chief Economist. And it was a year ago, Jeffrey was helping us with this type of presentation and how fast and what an amazing year we've had. Jeffrey is very experienced in the industry. He has a BA from Bob Jones University in math, and he has his master's and PhD in economics from Clemson University. He also has a research appointment from Harvard. He serves on various boards in the industry, and personally, he's the father of two, happily married, and has a passion for music. He conducts a vocal group as well as is an avid trumpet player and guitar player. So thank you, Jeffrey, so much for joining us today. And wow, what a year we've had, and there's so much to talk about. So let's begin. You've been doing a lot of these presentations all over, and what are notable things that you think would be interesting for our clients and our viewers today?
Yeah, Sarah, thanks again for having me. And it has been a year, and we talked last time that a recession was not in the cards. That turned out to be the case. We talked about there's still going to be opportunities in the markets. That certainly came about. And so now I get to talk about 2026, and maybe 12 months from now, Sarah, you can ask me, okay, how was your forecast? What's your record? So at this point, what I thought we could do is I'll share a couple slides that illustrate some of the hot topics for today. There are a lot about where the economy is heading, especially with trade, labor markets, what's going on with the Fed, what about political independence, then equities, is there still more room to run? What about bonds? Yields have been all over the place, particularly in the last 48 hours. So I'll set the stage. I'm not going to talk too long, hopefully not too long, because I'd love to have Q&A with you, Sarah. I I think you and I are both in the same camp here. You don't want to hear scripted remarks. You want to have a dialogue. So I'm going to share my slides, if that works with you. And just to make sure once they show, you tell me if you can see them.
Yeah, I can see it.
All right, fantastic. So the policy engine, kind of a nod toward not just policy, Fed policy, that we call that monetary policy, but also fiscal, tax, political policies that are coming out of Washington. No surprise there that when you think about it, the more things change, the more things stay the same. And so here's from an economic standpoint before we get to equities, bonds, commodities, and then alternatives. I'm going to touch a little bit about the dollar because that's always a hot topic, and then we'll open Q&A. So we have had quite a phenomenal run. And I'm showing you here just quarter on quarter GDP growth. This is very high level. And I just want to show you that, we've had a little bit of a downward trend in growth from, say, like 2, 3 years ago, right? We had COVID, then the reopenings, those numbers were just very unusual because when you have a reopening from a massive negative number, it's going to be a massive positive number, but it really doesn't tell you anything. Well, the last 48 months-ish, maybe even 24 months, we're in this position where the economy is slowing, but we're still growing above trend. And that's what we're showing here. So Q3 was phenomenal. We're starting to maybe move past some of the distortions because of trade. Remember what happened in the middle of last year. Basically, you have this announcement, hey, tariffs are going to start. Well, what does everybody do? Well, they're going to import real fast a ton in anticipation of tariffs being enacted in the future. So that huge increase in imports subtracted the numbers. That's why we have a negative number here, and then a massive rebound just because we weren't importing, and that imports, remember, subtract from growth because as your end client may not know, if they're not in the markets like we are, GDP just stands for gross domestic product. So it's domestic. Everything that we produce, goods and services domestically, which means if you import it, it subtracts from those numbers. It's not produced internally. But key point here is we have above trend growth projected for 2026. No recession in 2026 either. Now, granted, it's really important to remember, we often joke that a business cycle doesn't die of old age. It gets assassinated, meaning some shock outside the system hits, and that's where you get a hit to the economic growth. But at this point, growth above trend. It's pretty decent. And where it's going to come from, it's going to come from more and more this category that historically has been really small. So I think this is one of the reasons, Sarah, as you know, a lot of people are thinking, okay, are we in an AI bubble? Well, when you think about the big picture, we still are very, very in very, very small, skinny slivers of the pie. When you think about software, that's one of the categories of intellectual property products. Software, research and development, some of those aspects within business capital expenditures that are related to intellectual property. Think about innovation, right? Just like we talk about intellectual property from the legal standpoint, right? Attorneys that practice in patent law, intellectual properties, that know-how, and that's becoming an ever increasing part of the pie. So we're above trend, no recession 2026. We're going to be at that upper, maybe like 2.3% growth in 2026 in aggregate. A lot of that's going to come from the business side of things because of bonus depreciation, all that kind of thing. What's really interesting is you might say, okay, wait, if the economy is growing above trend, that means we're running hot. That means we're going to have high inflation. The answer is not so fast. What's kind of neat about this, I'm a huge fan of some of these supply siders back in the 80s. When you think about the growth of an economy focused on the business side of things, meaning, hey, we want to create an environment where businesses can produce more. Well, you can actually have an environment like the 90s where businesses can grow, the economy can grow, and inflation actually doesn't heat up because we're working on the production side, not necessarily saying, hey, here are stimulative COVID checks, right? Straight to the consumer. You don't want it. You don't want stimulus here per se. You want stimulus down here in the business side. So what's happening is growth above trend, intellectual property, artificial intelligence is a greater part of it. And at the same time, we're going to see maybe a little bit of near-term pain on inflation, but this is not even December yet. We don't have December data on the core PCE, which is the Fed's preferred metric. We're not going to see inflation really kind of turn back over until probably March or April. That's going to require a little bit of patience on the investor standpoint. Growth, inflation, jobs, those are the hot topics. Now, here's where the rubber meets the road. You think about, all right, one of the things that I get asked about a lot of times from friends, hey, should I buy a house? Should I get from being a renter to a buyer? I think 2026 is going to be a year where we can say definitively, phew, the high, super high mortgage rate levels are the thing of the past, and we will see a continuation of what we're already seeing now. 2024 was a really tough time for borrowers wanting to get mortgages. We're actually, I put this chart together last year, by the way, because we published our outlook in November. And we were saying, hey, look, when we were looking at, what's in the cards, looking at the data back in October, we said, no, inflation is going to ease up enough. I think Fed policy is going to change up a little bit enough, and the 10-year is going to ease up enough to finally give a little bit of relief for those that are interested in tapping the mortgage markets. So this chart's basically just your 30-year mortgage and your 10-year because that's the closest relationship. By the way, before I leave this slide, I just want to say just something real quickly on the Fed. The Fed makes a lot of headlines because they set a target rate that's really not necessarily a retail rate. It's something that's more important for those that are in the banking sector. So the federal funds rate, they're actually setting it these days in a range, is what the Federal Reserve targets. They have a target rate. Now, eventually that does filter through into retail rates, but it takes a little bit of time and it's not necessarily one for one. That's why I'm showing you in this chart not the Fed funds rate, but the 10-year rate as it relates to some of the retail rates. But the point is, 2026 might actually be a decent time to start talking to your friends, your kids, maybe your grandkids, depending on your audience here, Sarah, is that we will see finally some easing up on the retail rates in 2026. So that's kind of the big picture. Again, I didn't even talk much Fed, but maybe we can talk about that in the Q&A. Let's go into the question. The natural question is, okay, this is where that's the backdrop. What does this mean for your stocks, for your bonds, for your allocation and alternative investments? So, want to start out with this. Typically, when you have a bull market that seems to show some stability, you think about it was October 2022 where we hit that low. We've had several years of really great returns. What does that mean for the fourth year? Well, if you look at all the periods of time, this is no guarantee, but if you look at all the times where you had 3 years of a bull market, it's often a period of time where that fourth year it can stretch. Bulls can live longer than 3 years. They can get into their fourth year. Now, granted, again, no guarantees, but it's very possible that given the healthy environment for some of these businesses, that we can continue to see some growth even in the fourth year, despite really, really high valuations. Why is that? Part of the reason is when the Fed is cutting, but there's no recession, that's this scenario right here. The Fed is cutting rates, easing up on policy, and the economy is still growing. That's typically a good environment for stocks. Now, you might say, wait a second, why are you showing this chart? Well, it's helpful to remember most of the time when the Fed is cutting rates, it's because we're about to fall into a recession or we already are in recession. And that's not the case. It's possible, maybe recession risks might tick up a little bit going into 2027, but at least in the next 4 quarters of this year, we don't have that as our base case. Maybe a 30% chance, maybe even a little bit lower, 25% chance of recession, but we're not calling for one. So cuts with no recession, typically pretty good for investors that want to put a little bit of risk on the table. Okay, I said something about valuations. I know I'm going fast. Sarah, you do have access to these slides, so if anyone is interested after the call, as Sarah, as you're able to share these. So we're going to keep moving at a pretty good clip, and then we can always talk more. So valuations, you think about that ratio, earnings per share, et cetera. Is that a predictive tool? Well, sometimes you might say it's kind of like in physics class. It's not kinetic energy. It's like the measure of potential energy. It's kind of gives you a context for things, but it's not telling you necessarily that, hey, we're at the max and the next leg down is coming soon. But I think it's helpful to remember when you think about last year, the Mag 7, the Meta and Microsoft, Amazon, Alphabet, et cetera, NVIDIA, Tesla. Mag 7 was really taking a lot of the headlines, driving a lot of the growth last year. But when you think about stripping those seven stocks out and you look at the S&P 493, the 493 remaining companies of that S&P 500 index, you still had decent earnings growth. So we're suggesting that, going into 2026, even if we're a little bit optimistic on some of these earnings out of Mag 7, you still have fairly healthy corporate balance sheets for the S&P 493. Okay, so let's talk midterms, and then we'll talk bonds, commodities, alts. So when you think about the political influence and how things behave during periods of voter movement, maybe greater voter attention to what's happening in policy, you typically have a pretty decent time. So this is the first year in office. This is the midterm. This is pre-election. This is an election year. So it's very often the case that when you're going into a higher political cycle that does naturally increase volatility. So there's your realized volatility is this diamond shape dot there. Obviously for reasons like, hey, we're going to do this, we want to do this, a lot of headlines. But we often see the economy get juiced a little bit, right? There's often this period where you want to those that are in political power want to say, hey, we're doing a great job, keep voting. And that often does show up in equity prices. So S&P 500 performance during these cycles does suggest that there's, as we go into a midterm year, maybe that's going to provide a little bit more boost to that slide I showed earlier about the length of a bull run. Okay, so this now going into to bonds, I want to talk just briefly about Fed as it relates to this chart. So this is just a relationship between the 10-year and where we see the trajectory of the Fed rate. So this is Fed target rate on the x-axis here. We think we're going to go closer to your 3.25 rate by the end of next year. So the Fed is continuing to cut rates. We don't think, by the way, they'll cut next week. So just take that off the table because they cut the previous meeting. They're going to meet next week. They're going to prepare markets for the expectations that we will see a couple cuts this year, despite inflation still running above target. And what I think that's going to do is you're going to see downward pressure on yield. So if you're around here that where I circled on the x-axis, you're gonna see about a 410. That's our forecast for this year, about a 410 or so range on the 10-year Treasury, which means, okay, we're not going to see a sell-off like bonds did, say a couple years ago. It was a tough, think about 2023, for example, a tough time for bond investors. We think that that 60-40 portfolio, maybe it could be a little bit taken out of some of those and put into alts, but we think that bonds still have some opportunities in 2026. And this is just illustrating this, that spreads are pretty tight, meaning that there's uncertainty about what the global demand will be for our treasuries in 2026. But we do think that given the structure of the global system, there's still a fair amount of stable demand for treasuries, despite all the headwinds of, say, very high debt levels in the economy, the uncertainty on trade, even the uncertainty on what the labor force might look like. So we're not seeing a lot of stress. Basically, this is just giving you, when you think about spreads, just to bring this down to, Main Street here. When you think about spreads, one of the reasons why we look at spreads is it gives us a measure of stress. So, I started my career in '04. just before the great financial crisis, one of the early warning signs that helped us identify, wow, something really strange is happening, is spreads starting to break down in, say, 2005, even early 2006. Of course, it was a lot more obvious, suggesting that there was some stress in the system, and hence we had the great financial crisis. Spreads are important at this point. Not a lot of stress in the system, whether you're looking at fixed income markets or not. So let's talk about currencies. Just want to say one thing about currencies, and then talk gold, and then we'll end it and we'll open up for Q&A. Big question that we always get is this: will the US dollar lose its global reserve currency status? And I think the very short answer is this: not in our lifetime, probably not in our kids' lifetime. Now, if things go worse, sideways or worse, maybe we're talking, 15 years down the road, we still have a fairly entrenched currency in any way you look at it. So one of the things I look at is SWIFT transactions, so cross-border payments. I like looking at FX transactions across the world. And then, of course, this is showing the percent of global currency reserves in other major central banks. Yes, we've seen some diversifying away from the dollar in the last 15 years, right? So that's 2001. We've seen some diversification away, but we still are saying, okay, this is 50%, right? So percentage of global currency reserves, that's right axis, we're right here. Over half of global currency reserves are US dollars. And the second and third place is not really close. So I think one of the things, from just kind of looking ahead, trying to forecast, look at look at this statistic, but also look at what are people writing contracts in, like commodity contracts. Are commodity contracts still majority US dollar? Yes. If that starts breaking down, that would be a helpful leading indicator. Hence, that's why I say, okay, maybe not in our lifetimes, maybe not even our kids' lifetimes, but that's something to watch that would help me change my mind, right? If there's a greater risk to the US dollar. It's entrenched in so much of global commerce that it's hard for me to argue that it's going to lose that currency reserves. Okay, so commodities, and this will be my last slide, even though we covered a lot, but I want to have plenty of time where we can just banter back and forth. One of the things that we're looking at in our research team, as well as answering questions, a lot of folks ask about currencies, sorry, commodities, particularly precious metals. I think it is helpful to think about holding and exposing a portfolio to commodities, not just as an inflation hedge. Remember back in the day, 10, 15, 20 years ago, it was, hey, it's an inflation hedge. Well, if the call, which it is, it's our call and expectation in my forecast on inflation, that inflation is going to ease up. It's really not an inflation hedge per se. It's really just a diversifier and a volatility dampener, and that kind of gives you exposure to alternative assets that I think have a demand, particularly because there's a demand for gold as a reserve. So you remember that chart I just showed you about central banks are holding less dollars? Well, they've switched it into holding more gold, meaning we're starting to see, and I think this is a long-term trend, that international central banks and larger sovereign wealth funds and large insurance companies are interested in continuing to kind of even add to their gold holdings. That's good. I think that's here to stay for the medium term. Hence, that gives you an opportunity to say, oh, you're not late to the game. Yes, we've seen a big rally in precious metals, but I don't think you're late to the game. There's still some opportunities there from a gold standpoint. So that's the very big picture. We have a lot of other things to work through, and maybe we can do that in the Q&A, Sarah. So back to you.
Yeah. Thank you so much. Those are very thoughtful points that you've made. And I was thinking, last year, I mean, the biggest change this past year is the new administration and some of the policies and ideas being put forth. It was a year ago, affordability was a big issue, and we were talking about eggs. As you talked about inflation, that you think in the near term it will continue to be pressing up, but then will come down. What would be some of the things that would help ease that for the consumer and make things more affordable?
Yeah. So just adding a little bit more color to the nuance of inflation. So inflation is a tricky thing because when the Fed looks at inflation, it's an aggregate number, right? So it's picking up things that are happening in North Carolina where I sit, as well as Sarah, where you are in the Pacific Northwest. And it's very difficult to kind of say, okay, of the all of the millions of prices that are out there, here's kind of your number. One of the things that's a little bit frustrating is the housing component on inflation, meaning that 1/3 of the CPI, not quite that high. Housing is not that large in the PCE deflator, so they're basically different ways of measuring inflation. Which, by the way, a lot of people, my mom will ask me, what's inflation? Inflation is just the change in prices, right? So you think about what's been most frustrating is, football tickets or, whatever you're buying, the increase in those prices that hit the consumers measured in a positive inflation rate. I think that housing is going to ease up, particularly the rental space is going to ease up in 2026. That's going to provide a little bit of release of that pressure on inflation. I do think that healthcare we saw and insurance, that was a thing that was really unusual, the amount of costs and increases that were just happening over and over and over on insurance. I think we're past the worst of that. And then in addition to housing, insurance, I think the other thing that you're going to start seeing easing up a little bit is on the good side. So that's a lot more choppy. So sometimes, you think about appliances, those big ticket items, cars, some of those categories. You're starting to see some signs of things easing up there. Here's where it's complicated. So businesses have been really reticent in passing along the cost of tariffs.
Mm.
We knew that from the Beige Book. That's why I think in the first part of this year, it's very possible that they might say, "Hey, look, we haven't passed along those tariffs for 3, 4, 5 months now. We're going to pass along a little bit, in the first quarter." That's where I think you have a little bit of this upward pressure still remaining. But by the time we get past, the Q2, we'll see, I think, inflation be decidedly lower. And my forecast is 2.3% by the end of the year, core PCE. So next time we're on, yeah, hold me to it.
Well, how about when I go to conferences, they talk about the emerging markets. You could consider the middle of the US, right? With all the reshoring that's going on and the building back, bringing jobs and manufacturing back. How do you see that progressing, and where are the opportunities for the young people that are looking to make a difference in that space?
Yeah, that's tough because I really don't see the signs yet of any type of renaissance in manufacturing. And I think what's happening is, our economy is a services-based economy. And despite the efforts from tariffs to try to bring some of those goods producing side of the economy, it's just not happening, unfortunately. Um, that doesn't mean that there aren't opportunities. It means that it's not going to be like previous times. So we're in a period where the demand for labor is just a lot lower. So I like the phrase, it's a no hire, no fire kind of scenario. So no hire, well, that's not good, but no fire, well, okay, well, that's good. It's no hire and no fire, meaning we're in a we're in kind of a stable market for jobs, but it's not a hot one. So typically an economy like ours that's growing above 2%, you'll see payrolls grow by 150, 170,000 jobs every month on average. I think we're going to see about 40,000 jobs on average every month. So it's just a lot softer. I think in some ways, what does this mean for, particularly, Gen Zers? They don't have the resume, they don't have the experience. Um, you know, the entrepreneurs, maybe those that are, willing to take risk in that way will see some benefit. But I do think we're still going to see a services-based economy, not a goods-based economy.
With AI being such a driving force, not only here at home, but in the world, and we're the biggest exporter of it, with the and yet the need for resources and data centers, how do you how do you see that morphing over the next couple of years?
Well, I was just in Arizona for some of our LPL clients, and very popular to have the data centers that are all over Phoenix, and so interesting to observe all the secondary and ripple effects that come from data centers, right? So you have all this demand for cooling, right? These buildings are getting hot because of the computing going on, so they want to have these huge units trying to cool them off. I think what we're seeing is we're still in the early stages of the infrastructure build out. Interestingly enough, we probably won't see the benefits to productivity and jobs for maybe another year. In fact, someone was just asking me this recently. I said, I don't think it's going to be like a late 90s, early 2000s internet thing as businesses were transforming and responding to the work that the internet was providing us in the late 90s. We have that infrastructure. And so AI is kind of just an add-on to that. But I think there is continuing to going to be this lag between building out all the infrastructure and then getting the benefit from all that build out. So 2026 is all going to be about the infrastructure build out. By the way, it's interesting. Some of the real labor intensive industries like hotels and restaurants, even health services, do not have a really high utilization rate for AI yet. It's quite interesting. For your listeners, if they're interested, there's a company called Ramp, and you can get this data. It's free, it's off their website. But Ramp measures utilization rates by, thousands and thousands of companies across the U.S. in 100 different sectors. And it's fascinating to me because it gives me a little bit of insight. Okay, there's a lot more room to go. Like for example, like even in the construction space, health services space, utilization rate for AI is like 30%, meaning that there's a lot more to go. It's hard to say if the hype is going to pay off or not. We're too early on that, but I do think that we're going to continue to see that build out as you reference on data centers, et cetera. But we got to wait and see. Maybe 2027 will be the year where productivity growth really blossoms.
Yeah, that's that makes a lot of sense. With the way information flows, right? There's so many headlines, it can really create a lot of emotional angst from readers. Um, we've been talking about I mean, there's the doom and gloomers that are convinced it's another 2008. I don't see it. I think it's a fascinating time to be an investor and to be alive, and I see so much opportunity. What 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 do you see on your horizon? Are we like a correction? Is that something that you think is imminent, or is that something that, or it's a balancing act with these new policies and these new jobs that are coming back that are different than the old jobs? What are your thoughts on that?
Well, I think a couple of things. First is it's really helpful to remind, your clients and your audience that you don't want to chase headlines. That's not a good strategy. We have a lot of headlines uh, in the new administration, but it's not not a good strategy to try to chase those. I do think, though, what's interesting is, this feels very different than, say, the years going into the great financial crisis. I referenced, when I started my career. So some of the fragilities of the market are indeed there as a potential risk, but it's not 2005. I don't feel like it's the same kind of scenario with 2005, 2006. But that said, I think it's also, and this is kind of my third point to the answer here. I think corrections are healthy. Yeah, I think in some ways, it's kind of like a retuning of things, saying, okay, we don't want to go over our skis here and get overexcited and having this huge rally with only one direction that's up. Corrections are healthy. It's an opportunity to kind of reset, think through, okay, where are the opportunities between the different asset classes. So I don't know if we should be afraid of a correction, but I don't think we have the ingredients that would make an outright bear market or a crash like an '08. I don't see a Bear Stearns or a Lehman Brothers, or a Wachovia, all those banking disasters. I don't see that in the cards right now. Now, granted, there could be geopolitical shocks. I think the biggest risk, of course, is, what if China goes after Taiwan? Taiwan is very, very important for us as it relates to semiconductors, things of that nature. Geopolitical risks are still there, but I don't think we have the financial stress that we had in previous major market sell-offs.
What do you do as the chief economist? And I mean, I personally, when I get up in the morning, it's almost like I'm so looking forward to the headlines to try to see what's happened, right? Because there's so much to look at. What resources do you and your team use that help to keep clarity and calmness, but keep up on all these shifting stories? How do you do that?
Yeah, well, I think it's very important to look kind of in the plumbing of the capital markets. How's the flow of trades and the interaction, the transactions? Uh, you know, Everybody sees the end result that's published, and broadcast, all over the internet and however you access your news. But underneath all that, in terms of that plumbing, it's really, really helpful to kind of understand the health, right? It's kind of like, okay, the guy looks fine, but let's put a stethoscope and hear his lungs. Are those lungs nice and clear and healthy? And things of that nature. So the plumbing of the capital markets, of course, in addition to that, looking at the potential stresses in how businesses are accessing credit and using the cash on hand that they have. So looking at the fundamental kind of, vital signs from the corporate side, and then the fundamental vital signs for the consumer. How are they doing with servicing their debt? Debt is not necessarily bad if they can service it, right? So are they servicing their mortgage, their credit card, their student loan, their automobile, whatever credit uh, conditions and variables and relative to their earnings, right? So how are they servicing debt? Some of the vital signs on the consumer side, and then outside of that is what's going on with households? Are they working? Are they being productive? And how easy can they find a job when they want one? Some of those vital signs, I think, are very, very helpful as it builds up the case of what the macro context is. Uh, I think one thing that's also very, very important, and it's unique to being in this country, is I also look at, how healthy is our legal system? Are people able to protect their intellectual property? Speaking of intellectual property, because the world will come here to innovate if innovators know they can reap a return on the investment that they made. So I think that I guess you could say a cultural and legal component of the business world is very, very important. So I look at those kind of metrics as well.
Okay, that makes a lot of sense. That's great. Well, thank you so much. This has been so fantastic having you here and giving us a glimpse into your team and thoughts on the economy. And on behalf of LPL and being part of the Fulcrum family, we're just really lucky to have you on our team. So it's just such a privilege to have to be partnering with LPL, and you guys are the back engine and the engine behind my team and I. So thank you very much for joining us today, Jeffrey.
You are most welcome and anytime.
Great. Thank you. And thank you all. We'll be sending out a replay of the webinar, and anybody that would like what Jeffrey responded shared about his PowerPoint presentation, we're happy to send that out. So thank you so much. Bye-bye.